Hello, everyone. Welcome back to the channel. Today, we are going to be covering an IBC case example, a case study of a real estate investor that, using the infinite banking concept, is actually going to retire, roughly speaking, 60%, 66% actually, wealthier than if they did not use the infinite banking concept. So stay tuned. We're going to be kind of walking through this. This may be a little bit longer of a video. And as always, I am not an IBC professional. I'm not an insurance agent. I'm not a certified financial planner. I just really like personal finances and I am into alternative finance, I guess, like the infinite banking concept, like velocity banking, you name it. Um, and so today, what I wanted to cover is essentially the idea of a real estate investor. And so let us look at an example. Let's look at a 30-year-old who is looking to invest. Healthy individual can save $20,000 per year and is going to look at buying properties that are worth $500,000 with a 20% down payment. And thus, we are going to need per transaction $100,000. And so the idea is that we are going to purchase these properties. They're going to be cash flowing. We're going to say that they cash flow $500 per month in profit, which I think for a $500,000 building is probably on the conservative side. And thus, each property is going to generate $6,000 per year. And we are going to assume in this example that the mortgage is paid for, the property taxes are paid for, all the maintenance expenses, everything, 500 bucks per month is going to be the pure cash flow generated from these properties. At least in my experience with the real estate that I own, this is not a uncommon number. In fact, it is a little low, at least in my area. So first, we're going to look at this, and there's going to be a few assumptions. Okay, so we are going to assume that inflation doesn't exist. It's going to be an apples to apples comparison. Actually, it's going to help the cash side. If anything, we're going to assume that the price of properties always stays at the $500,000. We're going to assume that rents never increase, which is going to obviously help things for both scenarios. And we're going to assume that taxes, everything like that, is going to be completely apples to apples. All we are looking at is the performance of saving money through the infinite banking process and leveraging that process to generate additional wealth versus simply saving cash and investing. Okay. Now let's look at first what these two things look like. So we're going to compare the cash side versus the infinite banking side. So what do most people do? The idea is this 30-year-old male on the cash side is going to earn money and he's going to save this money in a savings account because, as per traditional investment wisdom, he needs the money in a relatively short period of time, and it also needs to remain liquid unless there'd be a catastrophic, repair that needs to happen, which we're not factoring into this to make sure it maintains apples to apples. He is not going to be investing it in anything that yields interest. It's simply going to be a savings account. Any of the rental income that he gets, so savings, going to buy the property rather, and then it's going to generate rent. And then the rent, he's going to put it right back into the savings account. So this is going to be his flow of money: earn, save it, buy, rent, savings, right? On the infinite banking example, however, let me move some stuff out of the way. We are going to earn money. And instead of saving it in a savings account, we are going to put it inside of a IBC designed, I guess, whole life insurance policy, which is high cash value. Okay. And then what we are going to do is we are going to borrow the money. This is an arrow, by the way, not a dollar sign. We're going to borrow the money to then buy the property, which we're going to generate rents from. And then we're ultimately going to pay back the loan that we generate. So it's very simple. We are not factoring in, potentially refinancing the properties, or we're not even going to account for the equity in the properties, quite frankly, because assuming that these examples are done the same, it would be an apples to apples comparison. Okay. So these are the different circumstances that's going to happen. So let's look at the cash saver first. So let's zoom in here. So essentially and these are the end of the year, just so you know. So at the end of year one, right, thus he'd be 31 when he starts 30. By the time he's 31, he'd have 20,000 saved. So he puts 20,000, and then he puts an additional 20,000, which makes it 40,000 plus 20,000, which then makes it 60, so on and so forth, until the fifth year when he would have 100K. But of course he goes and he subtracts a withdrawal from this at the end of the year to buy his property, so he is now at one property. This property starts to generate him profits in the next year of $6,000, and he puts another $20,000 into it plus his $6,000, which leaves him with $26,000, so on and so forth, until the ninth year when he has $104,000. He withdraws 100 grand to make a deposit. Now he has two properties, and so on and so forth, up until the point that at the end of this, he has 13 uh, properties under his name, and he is going to be generating $78,000 per year of rental income. Now, quite frankly, after 30 years, this rental income probably would have doubled at least, but we're just going to assume that it is going to stay the same, right? Fast forward to the time. Fast forward to the time that he is now 80 years of age. He has $2 million in the bank, and he is still generating this nearly $80,000 with these 13 properties. So this is what this cash looks like. Now, the thing that a lot of people don't understand when they consider the infinite banking policy is that now you're going to have cash surrender value, which you're then going to borrow from, which you're obviously going to have to pay interest on. How can you introduce interest in here where it equals more than this? Well, remember, it's because right now this cash does not generate any money. So the beauty of the infinite banking policy is as you deposit your $20,000 per year and it continues to grow up until the point where it's, say, $1 million, well, your money, despite the fact that you've borrowed a lot of it over here, continues to grow and compound as if it's $1 million, not minus the amount you've borrowed. Whereas here, even if you were earning interest, you would be earning interest on $80,000 until you withdrew the money, and then ultimately that interest would stop on that money because there'd be no money in the account. This is the critical and key difference. And you'll see when we look at the example, it allows the individual that's practicing the infinite banking policy, the infinite banking process, to actually have roughly 66% more wealth at the end of the day. And in fact, continue to have more wealth for the entire period of time, with exception of the very, very beginning. So let's look at this here, and we're going to take a little bit more time on this side. Now, one thing that I will say that I forgot to factor in on this, although I did do some rough calculations and it only changes things relatively minorly, is that I have said that the available cash value to borrow is equal to the total cash value minus the outstanding loan. This is actually not true because typically you can only borrow, roughly speaking, 90% of the cash surrender value. Now, this may change depending on the lender, but it is what it is. I'll admit that I didn't factor that in here. It changes one property. Thus, at the end, you'll see here this individual owns 14 properties at the end. It will go down to 13 properties, same as the cash, but you'll see it still is a tremendous amount of wealth at the end of the day. So let's look at this again. It's a 30-year-old male, healthy, non-smoker. $20,000 is how much this individual can save. And I am assuming that rather than borrowing direct from the insurance company, which typically has higher interest rates, that this individual is going to go and secure third party financing. And that this financing would be 4.45%, which, for anyone curious, is the current interest rate of making this video that Equitable Bank offers on cash surrender value lines of credit, essentially. Okay. So this individual, rather than going and saving this cash, is going to make, at least based on traditional advice, the unwise decision of investing his money into the whole life insurance policy. And I say investment because you will see it makes significant amount of difference. And so he puts $20,000 in, and after the first year, he has lost 20%, and he is now at a roughly $16,000. And again, he puts 20,000 in the second year, the third year, the fourth year, and he has $78,000. And on the fifth year, he deposits 19, and he actually has $99,684. For argument's sake, I am going to say that this individual is able to scrounge the 300 and some odd dollars that he needs in order to go and make this $100,000 deposit. If you're going to give me grief about this, I'm sorry, but that's the assumption that I made because you could take it off a credit card, a line of credit, whatever, if he really, really, really needed to. Not that I'm advocating that, but I'm just saying if it was really a necessity. So, like in the cash example, he is going to take the rental income, which starts in the next year. But instead of putting this into his savings account, he is going to actually repay the loan with it. But there's now interest. So the interest on the outstanding loan balance for the year is $4,435.94. And then when you apply the $6,000 payment to it, it leaves an outstanding balance of $98,000. And of course, he's going to continue to fund $20,000 a year. Fast forward to year 9, same as in the cash. Let's zoom out here. Same as in the cash. Year 9, he is going to go ahead and have more than $100,000 in the account. He's going to take out a withdrawal or a policy loan or leverage the line of credit, however it needs to happen. In reality, you don't really want to withdraw because that removes the compounding. So forget I said that. I'm not going to edit it out just because I don't like doing these in big orchestrated fashions. Okay, we're real here. So now his loan is $192,000. The rent on that does not begin till the next year because remember, these transactions occur at the end of the year as per this example. He's now making $12,000. The interest cost nearly doubles. And of course, he continues the same thing. And in a mere 3 years from the day that he purchased this property, he is now going to buy. So he's at 1, 2, his third property, and so on and so forth. And you can see at the end here, this individual is buying a property nearly every single day. And at the age of 60, he is now making $84,000 a year because in this example, he has one more property. And he currently has available to him $115,000 of cash value that he could use for whatever he wants. His interest costs are $50,000 a year. Now, apples to apples, it would look like this individual is worse off. But remember, the idea here is that we're going to attempt to maximize wealth. So let's look at what happens when we go and fast forward to age 80. So we fast forward. He has now $3.4 million in cash value. He only owes 31 cents. And he continues to make this $84,000 amount. I just put 67 here because it zeroed everything out, roughly speaking. So it's actually quite a phenomenal system. With the same monthly deposits, he has generated an additional property in this example, understanding the discrepancies with this. He has generated significantly more money. Now, how much more did he actually generate? Well, in the cash only example, he generated $2 million of cash. In the infinite banking policy, he has $3.443 million, which is a difference of almost $1.4 million, which is 66.3% higher than the $2 million that was generated otherwise, all from the exact same amount of cash that was generated. Now, again, this is making significant assumptions in the sense that, for example, if rents were increasing, this outstanding loan would drop. There's over $1 million of interest payments through this 30-year period, actually 50-year period, actually. Over $1 million, which means that if you were to reduce that cost, this would be significantly higher. You are able to do all kinds of things with the real estate in terms of refinancing, reducing the effective interest rate. I mean, the list goes on and on and on and on for the benefits of using the infinite banking policy for the purposes of real estate investing or any type of investing, to be quite frank. Because I haven't factored in the values of the properties. Because remember, we're assuming there's no inflation. We're assuming that the properties stay the same value. We're assuming the rents stay the same. I mean, you name it. But the truth of it is, because you're able to buy property sooner on this side, in real life, because of inflation, because the costs of things go up, you're actually going to fare even better on the infinite banking side. And this example assumes that at the age of 60, both individuals just stop investing entirely. The infinite banking side will only get better and better and better and better and better. Another thing is this is assuming that the individual only continues funding this with $20,000 a year. I mean, honestly, the list goes on and on and on and on for the benefits, but I hope this shows you how the infinite banking policy for the exact same amount of money invested allows you to retire significantly wealthier. When individuals talk about a whole life insurance not being an investment, I quite frankly think they're wrong. Now, in this example, 2 million versus 3.4 million in today's dollar, these individuals are probably going to retire comfortably, the two of them. But, in future dollars, these numbers may be closer to the same, where this discrepancy ends up being significant, right? Or if we scale this down and imagine if the individual was going to, try to find more affordable real estate and try to buy something for $300,000 and only invest, I don't know, $10,000 a year. The numbers still work out. It just obviously takes longer to achieve the goal that the individual wants to achieve. So I hope this makes sense. And as always, if I've forgotten anything, if I've missed anything, if you have any comments, questions, concerns, let me know in the comments below. I respond to everything, and I will catch you in the next video.